Today, Bitcoin hits a 13-month high amid the institutional interest in crypto. FTX objects to BlockFi's bankruptcy plans, and Ether Capital CEO Brian Mosoff weighs in on the recent burst of applications for spot Bitcoin ETFs here in the US. Welcome to CNBC's Crypto World. I'm Jordan Smith. Crypto prices are pretty much flat today, with Bitcoin rising slightly, trading around $30,400 at around noon Eastern. Earlier this morning, Bitcoin touched a 13-month high following comments from BlackRock CEO Larry Fink on the firm's application for a spot Bitcoin ETF. Specifically, Bitcoin climbed to around $31,450, but gave back those gains after better-than-expected jobs data increased investor concerns around the path of interest rates. As of noon Eastern, Ether dropped less than 1%, trading close to $1,900, and Polkadot also dipped, trading at $5.15. Okay, let's talk about the top stories. The CFTC reportedly thinks that Celsius and its former CEO Alex Mashinsky broke U.S. rules by misleading investors. Bloomberg reports that the commission's enforcement unit found that Celsius should have registered with the CFTC and that Mashinsky also broke rules. It also reports that the agency could file a federal court case if a majority of commissioners agree with the unit's findings. Now, we reached out to the CFTC, Celsius, and a lawyer for Alex Mashinsky, but haven't heard back yet. At the same time this is happening, Celsius is still moving through with its bankruptcy, including a deal with a group of buyers dubbed Fahrenheit, which will take over the company, give it about $500 million in crypto, and build mining facilities as part of the new business. Next, Valkyrie refiled with the SEC for a spot Bitcoin ETF, and it plans to use Coinbase as its surveillance partner to detect market manipulation. We told you yesterday that BlackRock also refiled its application and mentioned its own surveillance sharing partnership with Coinbase. The Wall Street Journal reports that the recent refilings come after the SEC felt the initial filings were inadequate. Valkyrie said Coinbase is the operator of the largest United States-based spot trading platform for Bitcoin, and that's the point that BlackRock also alluded to, noting that the exchange represents a significant portion of US-based Bitcoin trading. Last, FTX just objected to BlockFi's bankruptcy plans. In a filing submitted on Wednesday, FTX and its debtors claimed that it's fighting an attempt to subordinate or devalue their claims against the bankrupt crypto lender. FTX says BlockFi can't wave a magic wand and make the claims disappear. Bankrupt crypto hedge fund Three Arrows Capital also objected to the plan on July 5th for similar reasons. The SEC filed its own objection over which members of BlockFi's management would get releases. We reached out to BlockFi about these objections, but haven't heard back. All right, we told you earlier that Bitcoin touched its highest level in 13 months as the drumbeat for institutional demand grows louder. So for our main story, Crypto World's Talia Kaplan spoke with Brian Mosoff, the CEO of Ether Capital, which helped launch the world's first spot Bitcoin and Ethereum ETFs a couple of years ago. He weighs in on the recent burst of applications for spot Bitcoin ETFs here in the US and what it means for the industry.
We've been hearing a lot about crypto ETFs recently. Last month, BlackRock, the largest asset manager in the world, filed for a spot Bitcoin ETF. Other financial institutions like WisdomTree, Invesco, and Fidelity also proposed their own applications. But more than 2 years ago, your company, which is based in Canada, actually helped launch what you say was the world's first physically settled Bitcoin ETF. At the time, you called it a groundbreaking investment vehicle. Why did you think this was important back then? And what do you make of this recent push into crypto from financial institutions? What do you think that signifies?
We built the world's first Bitcoin spot ETFs with Purpose Investments a couple years ago because it's clear that the asset class is here to stay and people are looking for exposure points. A structured product like an ETF is more tax efficient. It abstracts away things like custody risk for the end user. And so for those who are institutions or retail investors who don't want to take on signing up on exchanges or figuring out how to custody the assets on their own, it's a far cleaner access point for those individuals. There was renewed interest in the space, certainly in the second half of 2020, as you saw Bitcoin go from just under $10,000 all the way up to in the mid 60,000 US range. And so we ended up with over $1 billion into those products. Alongside the Bitcoin ETF, we also launched with Purpose Investments an Ethereum ETF. And so, people are looking for access points. In the second half of 2020, there was renewed interest in the space following a prolonged bear market for a number of years. And I think as we move into the latter half of 2023 and 2024, you're seeing large US asset managers again recognize that the asset class is here to stay. They're going to be creating access points that their clients are going to want to purchase exposure through. And that's a good thing for the industry, and it's a good thing for the investors. It's good all around. Now the question is, when will the SEC be comfortable with bringing that type of a product to the US market?
Overall, has there been a lot of demand for your spot Bitcoin ETF and your Ethereum ETF since it was launched back in 2021?
Certainly at the outset of the ETF launches during a bull market, there was a lot of interest, a lot of money flowing into those two products. As things changed in the latter half of 2022, there was less buying and less intraday trading, but that's fine. These things ebb and flow, and crypto certainly moves in cycles. We're currently probably leaving the bear market and about to enter some type of bull, or at least sentiment is turning more positive. And so those products are on the shelf and they're there for when people are ready. Ether Capital, my company, is staking our own treasury. I think we're one of the only access points in the capital markets for staking exposure. And so again, we just need more of these type of products for investors to be able to access. We want them to be able to choose which access point is appropriate for their needs, what they're comfortable with tech-wise, and then they can go out and either sign up on an exchange and buy the assets direct. They can look for something that's tax efficient or something that takes care of the custody on their behalf with the right disclosure and the right type of trading activity, and then buy that way. And so whether this stuff happens in the next few months or it takes another year to go through, I don't think it really matters. If the SEC drags their heels a little bit for the time being, that's okay. Eventually, one of these ETFs is going to get through. And again, that's a great thing for the industry and the investors.
Overall, what do you think investor appetite is for structured products right now compared to holding the assets directly, especially amid the current regulatory environment?
I would say that investors may not be looking necessarily at structured products today. The people who are buying the assets direct are usually ones who are a little bit more tech comfortable. Maybe they're a bit more internet native. And so they're buying, whether it's in bull markets or bear markets. Those people are following the industry on Twitter and deciding that they want exposure in their portfolios to the sector. The professional investors or retail investors who aren't following the space, who are more likely to buy a structured product, they may come at some point later. So I don't know if an ETF were to launch today in the US, if it would see billions of dollars of inflows on day one. But again, that's okay. It'll happen when the sentiment continues to shift positive. Where the sentiment exactly is at currently, I don't know, is that relevant? I think there's big catalysts on the horizon. When one of these ETFs gets approved, that'll be a very big deal. And the largest market in the world and one of the strongest crypto development communities is right here in the US. And in 2024, we have events like the Bitcoin halving, which is where the block reward, which happens every 10 minutes, this is new Bitcoin being created, that gets cut in half. And if you look historically at these halving events, which again take place every 4 years, they usually act as positive catalysts for price momentum to the upside. It may not happen the day of the Bitcoin halving, but they happen within a few months. Doesn't guarantee that it'll happen again, but it is something to look forward to. And as we start to see clarity around the regulation in the space, you've seen the EU put in place some new rules. Japan is leaning into the space, so is Hong Kong. And the US is going to sort itself out. And those are all positive things for the industry. And those who don't have exposure yet, who have been sitting on the sidelines, will feel more comfortable that the assets are here to stay. And they'll start to have more conviction and decide that it's time to have some exposure inside of their portfolios. So what happens in the short term is anyone's guess. But I think as we move to the second half of this year and move into 2024, there's a lot of things to be excited about in this industry.
So this week, we learned BlackRock refiled for its Bitcoin ETF after the SEC found flaws in its initial filing. So given your experience in the space, I know you touched on this, but what do you think will be the outcome? The SEC so far has not allowed a spot Bitcoin ETF to launch in the US. In fact, the agency is currently in a legal battle with Grayscale over whether the company will be allowed to convert its Grayscale Bitcoin Trust into an ETF. So what do you think will happen with BlackRock's application specifically?
My prediction will be that the SEC will continue to drag this out until they're comfortable or feel that it's ready to greenlight a spot ETF. Whether that happens in a few months or early next year, I'm not sure. But the pressure is on. If you were a government or a regulator, you should be in favor of ETFs because you know where the custody of the assets exist. When retail investors go and buy the assets on their own, it could happen on an unregulated platform. It could happen in a self-hosted wallet. It's harder to monitor the behavior versus saying, we understand that people want exposure to the price movement of these assets, and we'd rather them do that through a regulated product than through something that they can't monitor with as much ease. So there's a lot of reasons that government should lean into these ETFs, why regulators should be saying it's time. We understand that there have been filings for over a decade now. If you look at the Winklevoss brothers, they filed for an ETF where it could have been called a trust back then. That was 2013. So we've seen a number of filings come before the SEC. It was a far more nascent industry back then. There were a number of filings along the way in the 2017 and kind of 2018 era. And now we're here in 2023. You have $1 trillion worth of assets that are sitting in the industry. There's successful businesses. There's been businesses that have collapsed that weren't regulated. And so bringing more products to market that investors can have confidence in, that are appropriate, that are letting them invest direct in just the protocol assets versus equity in the companies, that's a very good thing.
Mosoff also provided his outlook for both the price of Ether and the volume of Ether staked. You can catch the full interview over at cnbc.com/cryptoworld. That's all for Crypto World today. We'll be back again tomorrow, and we'll see you then.